Unions expect employers to table a new improved offer.
With the little offer they have offered, which is even below the inflation, it's an insult, ignoring all the other demands which we have tabled.
Employers are pointing the finger at the unions.
We started with an offer of 4% on basic. We then moved to 5% on basic, and thus far the unions have not moved at all, not taken anything off the table.
As the stalemate continues, gold companies appear to be preparing for a strike.
They are putting up fences and gates at the various mines, so it's clearly they are preparing for a strike.
We will be negligent if we don't at least anticipate the possibility of strike action. And given, what happened last year, we can't have a repeat of that.
Ironically, gold shares rallied by as much as 12% yesterday, with investors shrugging off any threat of strike action. Meanwhile, wage talks in the coal mining industry collapsed yesterday. The NUM, Solidarity and WASA have declared a dispute after rejecting a final offer of 7% for the highest paid workers and 7.5% for the lowest paid. Mbongeni Mutwa, SABC News, Johannesburg.
Well, to break down some of the issues that are occurring in the gold sector, I'm joined by Zwelakhe Mnguni. He's an analyst at Mergence Asset Managers. Good evening and welcome.
Good evening.
Now, the gold price has been firming of late and the rand is relatively weak. Do you not think that perhaps the gold unions actually have more ammunition now in their negotiations with gold miners?
I think if they do, it's going to be quite a challenge, because what we've seen in the last quarter, or at least in the results we've seen recently, is reflective of the past gold price, the higher gold price. But in the last quarter, we've had a very weak gold price. So I would certainly think that going forward, the environment is going to be quite challenging for the gold miners.
There seems to be a bit of excitement about the fact that the gold price has been rallying of late. What have been the main drivers behind that?
I think if you look at the gold price got quite heavily oversold from around $1,600 to below $1,300, and I think one of the major issues has been the fear that the US could cut their liquidity support, what's been called a taper in the market, and that has been a big driver to put the gold price under pressure. But it got to a level where it became too oversold, and people were starting to speculate that it could turn in the other direction.
Now, my understanding is that gold is usually perceived as a gold haven, particularly when you've got the threat of high inflation. But globally speaking, inflation is relatively low. So what has suddenly changed fundamentally for people to start buying up more gold?
I think one of the things is that, like I say, it had been quite heavily oversold. The second issue was that if you look at the demand has come back because the price has fallen so much. The demand in countries like China and India has come back quite strongly, and it has given a number of investors some confidence that this price would stick. It won't go below what we've seen the last time.
Now, we know that different mining houses have different costs, of course.
Sure.
But on average, what sort of gold price do you think we should be seeing to be confident that most gold mining houses are making profit?
Yeah, I think you should be looking around $1,400 across the board. I think for example, if you look at Sibanye Gold, which has reported recently, they've had a cost of $1,221 to produce an ounce. So it leaves very little room for them to actually maneuver, and that includes the capital expenditure that's required to sustain the mines.
So in your view, it's justified that some gold mining houses are seeking to cut costs in terms of labor and anywhere else?
I would certainly say that job losses are quite unfortunate, especially in our country where we've got a history of high unemployment. But I think the situation calls for all the parties, labor, investors and management, to actually sit around the table and look at what is a sustainable solution, because I think when the gold price does well, a lot of times the management and shareholders tend to benefit, and the workers have kind of a kept benefit, whereas when the gold price comes down, management wants the miners to actually see their perspective as well. So I think we probably need to move towards an incentive system that allows workers and investors to actually share the risks. So I think a very good example would be what we saw at Kumba Iron Ore, where they incentivized all the employees, and that was quite a very good scheme that we would think. So that the workers don't only suffer on the downside, but when the upside comes, they also participate in the upside.
Very briefly, Zwelakhe, I wanted to ask you, your bread and butter is you're an investment manager.
Yes.
Would you put your money in gold stocks right now?
I'd be quite reluctant to put my money in the gold stocks, because over the last 10 years, I mean, the returns you've generated on the invested capital in these gold mines has been quite appalling. I think you've been looking around 1 to 7% for most of them, and that is not an incentive enough to take the risk of investing in these gold stocks. So from where we are sitting, we don't think that they are actually quite a sustainable investment vehicle.
And very quickly, in 10 seconds, if we do have strike action in the gold mining sector, what will happen to the gold price?
I think the gold price, there's a lot of gold sloshing around that's available above ground. I wouldn't think that it would be substantially material on the actual gold price, but it may be material for the actual gold companies, because they would lose out on production. So that's where I think the impact would come through.
Zwelakhe, thank you very much for your time. That was Zwelakhe Mnguni. He's from Mergent Asset Managers. Let's now take a look at how the African markets performed today.